Hello again, still Wednesday, still July 23rd. So starting yesterday, we'd been making a comparison between a long call and a calendar spread. We'd been trading both of them as a slightly bullish trade. Just some quick comparisons here. The cost of the long call is our maximum possible loss. It was 99 cents. It's on a per share basis, of course. The cost of the calendar spread was 59 cents, so less. There is an additional commission there because you've got two legs to the spread, but it's still quite a bit lower loss. The claim to fame of the long call: if the stock goes crazy up, so does your profit. The winning trade can be unlimited. I've never seen a stock go to infinity yet, but you never know. Calendar spread, the win is limited. It's very limited, but your probability of getting it goes up a little bit. Let's talk more about that. So here you can see what we paid for the two. There's our calendar. There's our individual call. Now, notice something. Actually, there's an easier way to show what I was just going to say. I was going to talk about time decay, but let's go to a different screen. So in the Thinkorswim platform, now part of Schwab, there's this turquoise line which represents our profile of payoff for today. If we were to go up crazy, we'd make a lot of money. If we were to go down crazy, it's capped at that 99 cents. Notice that the turquoise line, which represents today, is slightly above this gold or yellow line, which represents expiration. That's because we have a negative time decay. We bought the call, and until it starts trading with no time value at all, there's still some time decay. Now let's look at the calendar spread. And again, the turquoise line represents today. The yellow or gold line represents expiration. And notice that the turquoise line is below the yellow line. Now, if we were to try and close these right now, the individual call would be at a slight loss. The calendar spread would be at a slight profit, even with extra commissions. So I'll stop here for today and just mention that of the two, I prefer the calendar spread for this type of situation because your likelihood of having a winning trade is better. Also, your flexibility to try and repair the trade is possible, whereas with the long call, it's much more difficult. More on that in future days. Good luck out there. Bye for now.